Welcome back. As mortgages hit historic multi-decade highs, we should consider the mortgage spread, which factors in the amount of risk banks see in the marketplace. Now, the mortgage spread is calculated very simply by taking the 30-year average mortgage rate versus the 10-year U.S. Treasury, 30-year mortgage rate minus 10-year U.S. Treasury. Now, typically, mortgage spreads widen. The difference between the mortgage spread, or I should say the average mortgage rate and the 10-year U.S. Treasury, widens when banks see an extra amount of risk in the marketplace. Here we see the white line is a 30-year mortgage, which, by the way, is at 7.49%. It's the highest mortgage we've seen in quite a long time. We're going to show you exactly how long it's been. The blue line represents the 10-year U.S. Treasury bond, and we know 10-year U.S. Treasury bond yields are also hitting historic highs. Now, the black area chart in the background, that represents the mortgage spread. It represents the difference between the white line and the blue line, the 30-year mortgage rate and the 10-year U.S. Treasury. So we can see at times when the 30-year mortgage is further away from the 10-year U.S. Treasury, its mortgage spread increases. Currently, we're around 2.75%, which very simply, the 30-year mortgage is about 2.75% above the 10-year U.S. Treasury. Here, the red line represents the S&P 500, and the black line represents the mortgage spread. And notice the inverse correlation. When the stock market goes up, mortgage spreads go down. When the stock market goes down, mortgage spreads rise. Again, what the mortgage spread, what it does is it shows us how much extra risk the banks are pricing into the market. When we go to the bank and we say we want to take a mortgage out to buy a house, the bank looks at our credit score and our credentials, but it also takes a look at the economy and says, how likely is this lender, this borrower, what's their ability to pay back the mortgage? When the economy is in good shape, well, very good chance. But when the economy is shaky, the banks have to charge a little bit more for the mortgage. And that's why the mortgage spread widens during tough economic times. Here we can see the average mortgage spreads on the right-hand side. In 2014, the average mortgage spread was 1.65%. That means a 30-year mortgage was about 1.65% higher than the 10-year U.S. Treasury. And it's also broken down by month. So, for example, 2018 in January, we had a 1.45% mortgage spread. In April of 2020, we had a 2.67% mortgage spread. We'll take a look at the yearly averages. 2014 was 165, 2015 was 171. All of a sudden, 2020, that was a COVID crisis, mortgage spreads went up to 223. In 2022, with the emergence of the inverted bond market, which shows us a level of risk in the market, we had 235 mortgage spreads. Well, this year so far, January 275, February 249, March 291. In fact, the average for this year so far is 2.81%. That is the highest high we've seen in quite a long time. If memory serves, I believe the average multi-decade average for mortgage spreads is below 2%. So 2.81% is the highest we've seen it in quite a long time. Well, take a look at this chart. It goes back to 1972. The blue line is a 30-year mortgage. The white line is a 10-year U.S. Treasury. The black area chart are the mortgage spreads. Now, notice a couple different things. First of all, the blue line, 30-year mortgage. We haven't seen a 30-year mortgage this high since the early 2000s. That's the last time we saw mortgages this high. The white line, the 10-year U.S. Treasury, we haven't seen Treasury bonds this high since, well, probably 2007, before the financial crisis of '08. Take a look at the mortgage spreads. At one point, we saw mortgage spreads, and remember, we're up in the higher twos, almost 3% mortgage spreads. We haven't seen mortgage spreads this high since 2008, maybe even higher than 2008. And prior to that, we have to go back all the way to the early 1980s. So what this is telling us, and the banks are very good judges of the economy, this is telling us that the banks are asking for more premium on the mortgages versus the 10-year U.S. Treasury since at least 2008, and probably more likely going back to the 1980s. And all this tells us that, certainly the banks see a number of risks in the marketplace. So, they're asking for extra premium. And we're going to continue to watch this because it certainly is a very interesting development that has been, developing, has been working itself through the market over time. And we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.